Hello everyone, my name is Chris Titley and welcome to the FinTech Australia podcast. The FinTech Australia podcast takes listeners on a deep dive across the FinTech industry in Australia, focusing on the challenges, opportunities and big stories our community faces. Let's get to today's episode. Hi, it's Chris Titley here. As part of the FinTech Australia podcast, a series, we're joined by Patrick Coghlan, CEO of Creditor Watch. Patrick, thanks so much for being a part of this series and coming on the show.
Great to be here, so thank you for having me.
Mate, the listeners out there may have heard of Creditor Watch, but they may not have. I'd like you to sort of give a bit of a brief explanation about the business, where it came from and which markets they operate in.
Yeah, for sure. Thank you. So Creditor Watch is a commercial credit reporting agency or commercial credit reporting bureau, depending on what vernacular you want to use. But really, we see ourselves as a data and technology company. So we're providing credit risk information. So think of that as credit reports, credit ratings, credit scores, payment ratings, to allow both lenders and trade credit providers to make comfortable decisions when they're providing, terms to a debtor. And it's all about commercial, so B2B transactions. So think about, a manufacturing business that's supplying meat to wholesale meat suppliers, supplying meat to butchers. They want to check that the butchers are going to obviously pay their bills when they provide their goods. But more importantly and more relevant to today's podcast is, we're helping power a huge number of fintechs in Australia. So when they need to make that instant decision about, opening up a line of credit or providing a payment facility or something like that, Creditor Watch can provide that information via API directly into their decisioning system or directly into their platform, so they can say yes or no to the customer straight away.
And Patrick, we've obviously, as a consumer, you're pretty aware of your credit score, but as a business, it seems a little bit of a lot of moving parts. I'd imagine the idea of the business being around for so long, you'd have to have huge amounts of data points and have to be quite dynamic, I suppose, for dealing with someone that you may not have heard before.
Yeah, totally. That's right. So we've been around for over 12 years now. And we've been fortunate enough to build our customer base up well over 50,000 companies using Creditor Watch. And obviously we then plug into various data sources so we can actually provide, credit reports and ratings on Australian companies. So there's a mix of data sources, public, private, government. So we're obviously plugged into ASIC, the Australian Business Register. We've got tax debts coming through from the ATO. But then on the private side is, how can we leverage information from our existing customer base to help everyone make really, good quality and confident decisions around, lending and providing terms. So that could be in the form of creditors, suppliers, lodging defaults against companies that aren't paying their bills. We're also able to plug into, accounting systems to pull in receivables data to be able to, identify how companies are paying their bills from a payment timeline perspective. And when you've got the volume of customers that we've got, we're able to obviously aggregate it all, anonymize it, and then provide really good quality and predictive ratings and reports on debtors.
And Patrick, the last couple of years has been unprecedented globally with the global health pandemic and rising inflation and rising rates, etc. We sort of take the clock back a couple of years into through this COVID period? How did you navigate it all? What were businesses thinking in terms of the macro environment? And maybe now fast forward to where we are now.
Yeah. So it has been almost crazy, almost 3 years now. I think if we look back, Creditor Watch, we've been fortunate. We've always said we're recession proof, and we sort of proved that through COVID, and we're well set up, for the next sort of 12 to 18 months. But I think what we saw, particularly in those early months of COVID and lockdowns, was small and medium businesses would cut a lot of their spending, regardless of what it was. They were just trying to save every dollar possible. Whereas the larger businesses, banks, lenders, big business realized the power of data, and they actually increased what they were spending and sought Creditor Watch out sought additional data sources out so that they could make confident lending and risk decisions, but also complement any sort of data that was coming into their system, and we've seen that sort of continue through COVID, but I think what's really been important is that small and medium businesses have learned the value of and the power of data, and we're seeing, despite this, these macroeconomic headwinds that we're in, we're seeing small and medium businesses who would typically try to save money. They're actually investing in automation of decisioning, but also in helping in acquiring more data so that they can make better decisions and manage their book in the long term.
And with various macro factors as a small business, or even a larger business, when you've got supply chain issues, you've got staff shortages, you've got rising inflation, including higher fuel costs, you've got wars going on, etc. There's a lot of uncertainty around for small business owners, and I've seen a lot of LinkedIn posts about supporting small businesses and people that what can governments do, what can banks do, what can fintechs do, etc. I mean, in terms of the focus on free cash flow and cash flow now, what are you seeing in terms of your clients and that sort of maybe that laser tight focus to try and get an edge?
Yeah, definitely. I think operational leverage is the sort of buzzword that if we're not hearing a lot about it now, we certainly will be. And that's essentially doing more with the same or more with less. In the case of obviously the tech downturn, we've had this huge shift from growth at all costs. If we're looking really big picture globally, yep, growth at all costs to really good quality free cash flow projections and growth, and essentially if you can't show a path to profitability, then you're in trouble if you've got a raise in the yep, next sort of 12 to 24 months. But what we're seeing is the adoption of technology. So how can we have our systems doing more of the menial work for us, and then utilizing the human resources within the business to do more of the one-to-one with other humans. So anywhere that automation can be introduced and efficiencies can be introduced, that is becoming more and more important. But fortunately we saw that very early on in COVID, that adoption started very early on. So Aussie businesses are very resilient, and they're set up extremely well to shoulder what's coming at them in the next sort of 12 to 18 months. And I think the key message is that a lockdown is far worse than a downturn. So we're looking really good for the next 12 months. And
Patrick, as you mentioned, it's harder to raise capital now, and we will see what I think is probably a lot of partnerships, a lot of M&A, a lot of people trying to bulk up their businesses with tools that potentially 1 + 1 = 3, and you recently have done so. Do you want to talk about that, the why, the how, and what you're looking for in terms of that recent acquisition?
Yeah, definitely. And just before I get into that, I think you're spot on. I think what we'll see is there's a lot of businesses out there that are probably just products, and I mean that I don't mean to be disrespectful or disparaging. And I think those businesses that have got a great product will actually do even better inside a larger organization. It doesn't even have to be that big, but by combining those offerings, you'll actually have a much better overall offering for your customer and for your market. And that's sort of was our thinking in our recent acquisition that we just closed last month of a New Zealand company called Debtor Daddy that we will rebrand to Creditor Watch Collect. And essentially it is an automated collection tool, automated collection software. So everyone, regardless of whether you're a small business or a large business, if you're invoicing your customers or you're providing finance, lending, someone has to collect the money. What's the saying? That the easiest thing in the world is to lend money. The hardest bit is to actually collect it. So
okay.
we want to make that easier, and we feel that automated collection technology is that next step. We've got everything from automated customer onboarding through a separate platform or via API. We can set up automated monitoring and alerts. You can pull, obviously our data via API or via the portal, and that sort of, in terms of closing off the onboarding to cash collection loop, if you will, the whole client lifecycle. This acquisition fits in perfectly with our product suite. And from a practical sense, if I may, you're able to set up all of your customers on a collection path or on various collection paths, allowing the system to provide reminders to your customers as invoices, become either due or overdue. And then, of course, as they become more overdue, you can escalate the seriousness of those reminders and ultimately start to register a default if you have to, or refer it to a debt collector if that's the sort of endpoint. But we're interested in that automation and technology piece before an actual debt collector gets involved. So if you've got 10 customers or 10,000 customers, introducing that automation into the business is extremely powerful, and what that will allow internal teams to do, collectors or credit managers or accounts receivable, is they can then focus on either the customer service from a collection perspective with larger organizations, or dealing with those more hardship type of arrangements that no doubt we will see increase over the coming months.
Patrick, a couple of things I would like to unpack there. Firstly, it seems like New Zealand's a bit of a hub for producing companies that invoice and collections, etc. There's a few that come to mind. And secondly, on that, in terms of New Zealand, I mean, you're focusing here on Australia. Is there something that Creditor Watch might be looking at in terms of overseas expansion or global expansion, or is there too many regulatory hurdles and too many different layers of bureaucracy, I suppose, and by different countries?
Yeah, it's a good question. We're not actively looking to expand internationally. The acquisition of Debtor Daddy and the team, Matt and Mark over there, would really attracted us to them, and that was why we went international. I think that the good thing about their product is it's agnostic from a territory perspective. So it's actually probably easier to scale that or expand internationally with that product rather than a credit reporting bureau, because obviously we need a huge amount of data before we can actually start providing predictions. So potentially that'll be our ticket to international expansion. But for the time being, very much focused on Australia. We feel that one, I know that we're growing really well, and two, there's a huge market there for us.
Patrick, one final question, mate. The future of fintech here in Australia, it's been a pretty rocky ride the last 12 months or so, probably even less than 12 months or so, probably from the peak of public market valuation highs from a lot of these stocks and on a global basis. But why are you excited, or are you excited about the future of fintech in Australia?
Yeah, well, there was the obvious event, Intersect, a few months ago, and I think that there was the downturn had already started to bite, but despite that, it was absolutely jam packed, which was really good to see. I think Australia, we're going to be in a better position from an economic and financial standpoint to weather the storm compared to our peers in the US and the UK and Europe. Which is good, but I do think that there are going to be there's going to be some consolidation in the sector, and you and I sort of touched on that. And I think my hope is that there are some really good businesses out there that have the ability to, or have the foresight to go, we probably can't exist on our own. Let's look for a home for this product and see our dream come to fruition, but via a slightly bigger company, or a company that's a bit better funded.
Yep, no, mate, I agree. I think there's going to be a lot of opportunities to talk, to partner, for equity stakes, for whole of company M&A in the next 12 months, as well as the the ones that want to get funding, I think we'll be able to put the foot down as well. Mate, thanks for the chat. Congratulations on the recent acquisition of Debtor Daddy, and hopefully the new launch of the Creditor Watch Collect product we'll be watching with interest. Really appreciate your time telling us about the story of Creditor Watch, where you play in the market, as well as what you're doing in regards to enhancing the business tools for your 50-odd thousand customers that you mentioned, mate. All the best. Great to catch up at Intersect, and look forward to catching up at another point in time.
Yeah, that's right. Thanks. Really appreciate you having me on board today, and thanks to FinTech Australia.
Thanks for listening to the FinTech Australia podcast. I'm your host, Chris Titley. The FinTech Australia podcast is a collaboration between FinTech Australia and Sub11. For more information about membership options, news and the events coming up, jump on to the FinTech Australia website. Have a great day. Thanks for listening, and we'll catch you next time.